What's up, everybody? So I just made a few updates to the workflow, so I figured I would just make a quick video and share. I was busy all weekend, so I didn't really get much work done, but I am working on it tonight. So the stock prices is the same, so we're gonna pull the stock prices, the bid, ask, mid price, and the timestamp for the 9 tickers that we're looking at. And why it's useful is because it gives a fresh true price for each underlying. So we're pulling that right here. I demonstrated that in the last video I posted, so I won't get into that too much. The next step is to get all the options contracts. So we're going to get every call and put that expires within 45 days for each stock ticker. We're going to get the strike price, the expiration date, days left, and the ticker symbols. So again, we're pulling that right here. And I went through this in the last video, so I won't get too into this right now. And we'll come down to the next step. So now I added this step in right here. So I was not getting this previously, and I realized this is actually something that's very important to get for the analysis. So we're gonna get the IV data. So right here, you can see I came and pulled the IV data for our 9 tickers, and that is gonna give us the implied volatility for every option contract that we found. And why it's important is IV shows us how much the market thinks the stock is going to swing. The more IV is a better deal, but also a little more risk, but it's what makes the options a little bit cheaper, and then you can make bigger profits. So here's the code for that, and I confirm that it's pulling all the data. The next step was going to be to get the buy and sell prices for the bid ask. So we're getting the bid, ask, midpoint, size, and the spread for every option contract. And why it's useful is because it reveals the real trading price and liquidity. So again, you can see here, I come down and we get the market prices here, and we confirm that we got everything. So we come down to our next step, which is to get the Greeks data. We're going to get the delta, the theta, the gamma, the vega, the IV, and the current option price for every contract. And why that's useful is because the Greeks show how price, time, and volatility will hit the profit and loss statement. So it's really doing our risk analysis right here. And then we can see I came down here, and we can confirm that we pulled all the data, and we can move on to the next step. So then the next step is going to be the IV and liquidity analysis. So I added this analysis step in, which is also a very important step. So here, each option's open interest, trading volume, bid-ask spread, and existing IV are analyzed. And these numbers show us how busy the contracts are and how cheap they are to trade. So here's the script, and then we can see here that step 6, that we were able to pull all of this data for all of our tickers, and yeah, so we were able to confirm that we have this data, and it is all right here. So then we can come down to our final step, which is to run through our Black-Scholes model, and I have the code right here. I made a few updates with the new data that we pulled in. So we come down and we run the final Black-Scholes analysis here, and we see our trading suggestions for the trading day. So I also made a few adjustments to the Black-Scholes model. I was reading the code, and I noticed that the Black-Scholes model previously was only looking for bear call spreads. So I adjusted the script, so now it is looking for both bear call spreads and bull put spreads, and we can confirm here by seeing that it did pull all of this data. So yeah, I think this analysis is pretty much wrapped up and done for the Tasty Trade data. I think we have all the data points pulled and the full analysis complete. So the next video, I'll start pulling in data from other sources, and we'll see how we can incorporate that into the analysis. So yeah, that's it for this video, and I will post another video soon. All right, bye.